Hello everybody, this is Artur Wiśniewski, or maybe I will start in Polish. Witajcie wszyscy na konferencji Pasywna Rewolucja. Serdecznie Was zapraszam na panel dyskusyjny na temat tego, jakie są aktualne trendy na rynku ETF i funduszy indeksowych. Naszymi gośćmi będą osoby z Holandii, z Wielkiej Brytanii oraz z Czech. Zapraszam Was serdecznie. Hello everybody, welcome to our conference. It's Passive Revolution. Here are with us in our studio our guests, Deborah Fuhr, a managing partner of ETFGI, Martijn Rozemuller, CEO of VanEck Europe, and Martijn Luňáček from Portu. Hello everybody.
Hello.
Hey, good morning, Artur.
Let's start with the most important, the crucial question of our conference about the condition of passive revolution globally and in Europe. So what I basically mean is, how much do we invest in passive funds compared with other types of assets, of other products? Do we invest mostly in index funds or ETFs? Where do our assets, what are the asset flows, where our money, in which direction our money is going, what are the trading volumes? So can I ask you, Deborah, to start with this question?
Of course. So in general, I would rephrase it. I don't like to call them passive. I think if you think about them as index exposures, whether it's index funds or ETFs, what you find is most people look for active management where they feel they can find alpha by themselves picking individual equities or bonds, or they look for mutual funds that are active or hedge funds. But the reality is we know from data that it's very hard to find active funds that consistently deliver alpha. So increasingly people use indexed ETFs to generate their alpha through asset allocation. And what we saw earlier this year, it was the first time that when you look at the US, there's more money in the index space and increasingly going into ETFs. And if we look globally, this will not be our best year in terms of net inflows, it will be our second best year. So increasingly investors are using ETFs and index funds because they provide cost-efficient exposure and you know what you're going to get.
Yeah, I would add that here in Europe, we have the situation slightly different. You know, in US, if I remember correct the numbers, last year, for example, there were 4 times more money flowing into ETFs compared to active mutual funds. While in Europe, the ratio is even the opposite. Not exactly, but more money in Europe is flowing still into the passive mutual funds, not into ETFs. And I think it's a good mirror to the proportion of ETFs to the passive or the active mutual funds. As Deborah said, in US, we have the higher amount of passive ETFs compared to active mutual funds, while in Europe, the ratio is about 10 to 15% only in ETFs compared to the rest in the mutual funds.
I think it's always difficult to mention numbers and percentages when Debbie's there because she knows best. But to my knowledge, I think looking at the existing AUM, it's probably true that ETFs or index investments are still way smaller, and maybe the 15 to 20% is accurate. But I think if I look at inflows, especially for the countries that we're active in, I would guess the percentage of index-related investments is higher than 15 to 20. But Debbie, please enlighten us because you're obviously more aware than we are.
Yeah, I would totally agree. I think one of the challenges is for certain markets in Europe, you still have markets where advisors are being paid to sell products. And so that makes it difficult in many markets. And that's totally true if you look at Asia, look at Latin America, the advisors, private banks are being paid to sell products. So that is one of the challenges we see in Europe. But what we have seen is increasingly there is use of ETFs. And what will happen is advisors or private bankers or institutions will find ETFs and index funds make sense for something. And once they start, that's kind of the hockey stick, right? Once someone starts using ETFs, they begin to use them more and more, and they see how they can be a useful tool to help them do their job. So I think it's really hard to get good data for all of Europe because there's not reporting requirements. So even I that try to cover everything, it's impossible to know exactly, which is why I'm not saying it's X or X. But we do know globally, ETFs have had 41 months of consecutive net inflows. So I think if you look at the trend, regardless of the market cycle, we have seen that investors continue to put money into the ETF industry globally. And investors in Europe are still buying products that are listed in the US or other markets. So I do think that increasingly investors are using ETFs. And from our data, we know that more than half of the assets are held by institutions. So I think the unique proposition for your audience is to know that they're able to use the exact same products that pension funds, hedge funds, asset managers are using with the same annual cost and very small minimum investment size. And this is really unique for the asset management industry. You know, I've been doing this for over 25 years, and normally institutions have a big toolbox and low fees. Retail has a tiny toolbox and high fees. So ETFs have really democratized investing. And I think that's why once people understand them and start using them, they really find they can be useful in different ways.
I think you're totally right, Debbie. I think we're in a sort of a unique era where small retail investors have not only access to really cost-efficient investment tools, but also more and more, and perhaps Martijn can confirm, access to sort of the guidance and the education to use those tools properly. So I think that that's very unique. And maybe to add on the previous topic, I think as VanEck in Europe, we offer both active and passive, and that's the only source of data that I know really well. And I think in our case, more than 90% of the inflows is definitely passive. Active just sees very few inflows, and it's much more difficult to to attract assets there. So I think we're definitely in the momentum also in Europe that passive is starting to win. The one hurdle that Debbie also mentioned is definitely the fact that in some countries it's still allowed to pay for distribution, and that will change over time. The big question is how long that will take.
You say people are increasingly using passive funds or index funds, but who are those investors? I've just read Eric Balchuna's book about John Bogle and how he impacted Wall Street, and he's describing the structure of investors in Vanguard. There's like 50-50 or something like that between individual investors and institutional investors. But if we look, but it's just Vanguard, but market is wider. So let's look at it more widely. Who is investing in passive funds?
I think, as I said, it is really all types of investors. We see over 6,000 institutions around the world that use them. So I'm talking hedge funds, pension funds, insurance companies, asset managers, private banks, family offices. You also find financial advisors are increasingly using ETFs. And one of the big phenomena are that often the issuers of ETFs and others are creating model portfolios. So trying to help the advisors think about asset allocation, because increasingly advisors need to spend more time working with the family, thinking about tax and other issues. So model portfolios and platforms are very big. Robos are very important, I think, to educate people on investing if they're not financial professionals. And then increasingly, and retail is using ETFs. If you look at data out of the US where there's more studies, you saw that during COVID, there were 15% of investors in the stock market were new, and most of them were going to ETFs.
What I can comment from my side, as we see our clients, so speaking just about retail clients, because we are basically a robo, we do see two big groups. I mean, the majority, of course, are those long-term regular investors who are saving for retirements. But we see more and more people are using ETFs also for, let's say, a short-term exposure to some thematic or sectors or something. And it's mainly due to the increasing variety of the ETFs that are offered by all the emittents, and also due to marketing. What we see all the time is no media is covering, or very little is covering the broad market ETFs, because it's boring. Everyone's talking about sectors, everyone is talking about thematic ETFs, these innovative modern types, which of course that's trendy on one side, but for the long-term passive investment, those one who wants to play the pure passive play, that's not that suitable.
It's funny you mentioned that, Martijn, because I think if anything that I've learned over the last 14 years in the ETF business is that even though the most boring ETFs are probably the most useful and will yield the best performance in the longer term, they're also the hardest to sell, because people, they simply like the story. They simply like to have the odd chance of getting some outperformance. And I think that's one of the challenges as an industry that we have, to make people aware of this phenomenon. And if they do have the need to invest in a more exciting way, then probably sort of a core satellite approach is the best thing they can do. And yeah, so over the years we've adapted to that. 14 years ago we just had really boring broad generic ETFs, and yeah, it grew slowly. And one of the things that surprised me very positively, and I think for the Polish audience, this is something they can relate to. So Poland has a lot of firms in video gaming and esports, also listed on the Warsaw Exchange. Now, when we started a thematic ETF that was sort of addressing the video gaming and esports sector, I thought it was a nice gimmick and it would probably do well. But the way it grew in the first year really surprised me, and really showed that people do need to have at least some narrative, some thematic exposure in their portfolios just to get them interested. And I think the challenge for us is then to also sell them the boring stuff, because that's in the long term better for them.
Yeah, I think the thematic ETFs have replaced picking individual stocks, because people struggle to think, if they like the idea of video games, like what company should I buy? So I think for many, thematic ETFs have become what individual stock picking used to be.
I agree.
You said that in Europe we have also both institutional clients and individual clients. But what I'm thinking, because as far as I know, in Europe, this proportion is much different from the US. I mean, most investors are institutional investors. What is the reason? Is it that European investors don't know, I mean, individual investors in Europe don't know how to use the brokerage account?
Yeah, I think there's probably one or two reasons that at least I can think of. The first is that in Europe, people in most countries have been relying on their, let's say, collective pension schemes for way too long, and there wasn't a real need to start investing. In the US, that's been very different. So people simply had to get some knowledge and had to start. So that's probably the first difference. Then also, as we discussed earlier, the kickback system that is much more available here in Europe is also a drawback, because for a lot of the brokers and banks, it simply paid not to sort of use ETFs for their clients, not to make them accessible to their clients, and especially in the zeros. So between 2005 2010, that was a real issue for ETF issuers to get traction. So yeah, I think those are probably the two main reasons. But yeah, perhaps Debbie or Martijn have other reasons as well why it's a little bit different here in Europe.
Well, one that I definitely saw during COVID was, because I didn't used to watch a lot of TV, but clearly when COVID first hit in 2020, I opened my iPad next to my computer and I noticed that CNBC is kind of a marketing machine in the US for ETFs. When they're talking about what's happening with themes or sectors or countries, they have charts of all the tickers and names of ETFs talking about here's how you do this. We don't have the same media kind of coverage of ETFs in Europe as we do in the US. And, you know, as Martijn said, up until 2012, advisors across Europe were being paid to sell products. Then we had the Retail Distribution Review in the UK, Dutch RDR. So some of this is relatively new in terms of moving away from paying people to sell products. So I think it takes time. And I guess one of the challenges is a lot of the advisors don't understand ETFs. And when you don't understand them, they're not hard to understand, but you don't talk about something. You'll just talk about things you already know. And so we have seen that challenge of it's easier to always do what you do as opposed to change. I think that's true with us in anything we do in life.
Very philosophical, very true.
And definitely there is a huge, it's not only a trend over the last years, but generally here in Europe, the adoption of not only ETFs, but the investment products in general is way lower than in the United States. So for example, for platforms like us, like Portu, the even bigger challenge than, for example, draw people from high cost mutual funds towards the ETFs. The bigger challenge for us is to bring more people in the industry, you know, to compete against the non-consumption. Because especially here in Eastern Europe or Central Eastern Europe, many people are still scared from investing. They don't want to put money anywhere. And the biggest challenge for us is to convince them, show them the advantages, the benefits, and tell them it's easy, everyone can do it.
Martijn, is it true that in your country or the countries that you're active in, people are still confused about the difference between, let's say, speculation or gambling and investing? Is their basic fear the fact that they may lose their investments?
That's definitely a huge issue, and it's mainly given by the marketing. We still have here a huge marketing from some companies who market, you know, give me the money and I will deliver 30% return guaranteed. Yeah. You know, people give the money, they lose everything, and after that they say, okay, I'm never investing anymore in my life, you know. So that's something what we have to fight, definitely.
Thank you very much. You are all saying that index funds are increasingly gaining popularity, but which ETFs are getting the most popular? We have actually broad market and the rest. I mean, factors, thematics, sector, and alternative investments. Where is our money going? Which ETFs are getting most popularity?
Yeah, I think if you look, most people use ETFs for some form of asset allocation as a solution. And so even though this has been a challenging year, we've still seen the majority of net inflows going into equities. And for many investors, the money was going in or has been going into the US market. So although it's boring and we talk about themes and other things, the majority of money is still going into plain vanilla market cap. And I think the best illustration of that is most people globally know about the S&P 500 ETF. That was the first ETF in the US, SPY. And that ETF is going to be 30 years old in January, but it's still the largest ETF and most actively traded ETF. Now, the US is not the home of the first ETF. That was Canada, which turns 33 in March next year. But so you see the majority of money is going into market cap. But I think one thing that's unique for Europe is ESG. So if you look globally, and the assets in the ETF industry right now are about $8.8 trillion. About 1.5 is in Europe. So the US accounts for 70% of all the assets. If we look at ESG products, though, Europe accounts for 52% of the assets. So I do think that Europeans have a very different view about climate, about being social, about governance, and really embrace the idea that they should be supporting these types of investments. While in the US, you've seen that that has waned. When ESG products were performing well, people were putting money in. And technology hasn't done well, which often is part of ESG, which is also why the flows into thematics have not been that great this year. We've seen a lot of money going into smart beta, where people are looking for dividend or income, and sometimes min vol. We've also seen that in Europe, we have a huge array of crypto products, which people have been using a bit, a little bit concerned right now, but also active. You know, ETFs provide, it's a wrapper, it's like a mutual fund. So inside of ETFs, you could have anything. And so active ETFs, especially in the US, are becoming more popular. But I think one of the reasons ETFs are more popular in the US is partially because retail investors don't pay commission to buy shares or ETFs. And most investors in the US, people in general, will have a 401k plan. So they already are familiar with mutual funds, they have a brokerage account, so it's not that hard to get them to use ETFs. Well, the challenge in most other countries is getting people to open brokerage accounts, pay commission, understand how all this works is much more challenging than the US model right now.
Martijn?
Yeah, I was going to say nothing to add to that. I think it's it's the complete picture.
Yeah, definitely. Just maybe one thing to the ESG. That's something what we see here in Europe, and it's massive. You know, definitely if people are asked, because we have the also here in Europe the SFDR regulation, making all the companies, making for all the companies in investment sector necessary to ask the clients whether they want to take care of those ESG criteria while selecting the portfolio. So when people are asked here in Europe, most of them will stick to the ESG model portfolios because you know, they definitely firstly are more socially aware than, for example, the rest of the world, but also we have the huge marketing about the ESG and SRI investing and stuff here in Europe. So that's definitely combination of the SFDR regulation, marketing, and people being socially aware that makes the difference between Europeans and Americans, for example.
So you basically showed us which direction, in which direction our money is going, in which ETFs we are investing more and more. But what about the way we invest? Because the one question is if we choose active or passive fund, but another question is how we invest in it. Do we do it more passive or active? So on one hand, we have these broad market ETFs, which are still most popular, I guess. But on the other hand, I have seen recently a data which was showing, it was the data from American stock market, that the average period average time we hold stocks in portfolio is going down. It used to be a few years some time ago, and now it's like about 1 year. It's an average time we hold stock market, a stock in the portfolio, at least in the American stock market. So do we go in the passive or active direction in terms of the way we invest?
I think, especially during the first period of COVID, things changed quite a bit. I think there are two remarkable things there. The first is that for the first time, people actually started buying the dip instead of panicking. And I'm talking about retail. And the second thing is that obviously they started listening to other people at, well, certain online platforms such as Reddit. Now we all know about the meme stocks. I think the sheer amount of trading that happened there and the fact that it was all quite short term probably will have changed the figures, still has. I think on the other hand, the fact that there have been much more thematic ETFs in play has also changed the dynamics of the market a little bit. For instance, one of our ETFs that is focusing on the semiconductor industry, SMH, that is an instrument that we see large volumes of trading in, and people are using it as a way to basically play the sector on the short term. Now I think, or at least I hope, that opposite to that, there are still many people that will also have a buy and hold portfolio, because I think in the end, more trading will definitely not always lead to more performance, especially for retail investors. But yeah, you do see, and perhaps Debbie said it earlier, perhaps it's because when they in the past used stock picking to do their sort of gambling or speculating, now they pick more ETFs to do that. That will also have an impact. So yeah, you do see a lot of trading, and I still hope that for the majority, people also will have the buy and hold part of their portfolio.
Yeah, that's exactly what we see at our platform. We have as I said in the beginning, we have the two groups: the long-term saving mainly for retirement, or long-terms like buying a house in, let's say, 10 years, for example. And then we have I don't want to call them speculants, but those are the players,
adventurous investors.
Exactly. And the proportion, for example, at our platform is like 80 to 20 for the long-term buy and hold investors who are buying the broad indexes and investing for long-term 20 plus years or 10 plus years. So that's the proportion for us. And
yeah, I think maybe also because so many people were sitting at home during COVID, we saw, especially in the US, that some people moved some of their money into kind of trading accounts, and that was kind of their hobby because they couldn't go outside and go to sports or do other things. It's impressive to me when I'm in the US and I take an Uber somewhere that quite often many of them have become trading people during their non-Uber hours. And they get excited to talk about ETFs. So it's kind of surprising.
You're saying passive funds are gaining popularity. We invest in a different way. Some invest in more passive and some people in an active way. And the question which is often asked here in Poland is what happens if passive funds take over 100% of the market? Because if we look to the United States, there's the part of the market which is already 50% taken by passive funds. I mean, the US stocks. Other categories of ETFs or index funds are also close to this 50% border. So there's an open way to increase this share in the market. And some people say that maybe it will reach 100% of the market. And what will happen then? Will the market end up? Is it possible at all?
I don't think we'll ever see 100% being index-based investing. But as we get closer to more money going into index, there should be opportunity for active managers to use their risk budget and deliver alpha. I think part of the challenge has been the number of active funds that are closet indexers. And so what you find is it's hard for them to then generate alpha. And so I think that's in some ways their own worst enemy, right? If they're doing that, right? Because they're not going to be generating much alpha. So I don't believe the number is as high as some make it out to be in terms of how much is indexed, because it's also important to remember there are a lot of different types of indices today, right? There's thematics, there's smart beta. So they're not all kind of just buying the S&P 500. And so it's not like 50% of the US market is being index managed, right? So I do think that makes some difference. And also ESG is very different in terms of what stocks are inside of it. So I think all of these things would lead to it being impossible for index to get much higher than, I think, 50%. But every year, the challenge is we're told this is going to be the year for active management. And if you look at performance, you still find that on average, 7 out of 10 active funds don't deliver alpha in any given year. So the ability to find the one that's going to this year and then have them do it for 3 and 5 years is very challenging, which is why most people embrace the idea of I'll put some money in active and some in index. So it's not a question of only one way. Most do a little bit of both.
Yeah, I think what we are seeing with the increasing amount of index funds or money invested being in invest funds, the volatility is increasing slightly. The amplitude of ups and downs, especially in sectors or in some smaller cap areas of the market, the volatility is huge. But I don't really believe, as Deborah said, we will get even close to 100%, not even 80, being only passively managed, because we have a huge amount of active managers. We have the institutions, we have still the mutual funds, whether they stay being mutual funds or they will switch to being actively managed ETFs. And those will be people who will be doing marketing again and again, and they will be telling the stories. This year, as Deborah said, this year is my year. I'm the one who will generate the alpha, beat the market. And of course, people like the stories. They like to believe this professional with many academic titles and huge knowledge will be the one, and I will give money to him. So there always will be some active fund managers who will be taking care of the price discovery.
I totally agree with Debbie and Martin, and I think there's one other reason as well why it will never be 100%, and that is that in some categories it's simply not possible to build a good ETF to do a passive strategy. And for instance, in small caps, sometimes there's simply not enough liquidity, or underlying spreads aren't good enough. Some more exotic markets simply don't have the access that we need to trade. Sometimes it has to do with FX trading that cannot be done simultaneously with the equity trading, which makes it a lot harder. So I think that there are, from a practical perspective, at least certain investment categories that will never be done passively. So yeah, there will always be an active part of the market, but I also definitely think the passive part, especially in Europe and Asia, will grow in the next 10 to 20 years.
Thank you very much. Let me ask you last question. Let's imagine that instead of you, there is someone who hasn't invested in ETFs ever. And what would you tell him or her?
Start now.
How to start? How to invest? Maybe you could share with us your preferred type of investing in ETFs, and is it possible to build a full portfolio using ETFs?
Well, what we are saying, for example, to our clients is that start now, start as soon as possible, start with small amount of money. You don't have to put everything in the market at one time, definitely not. You know, make some regular deposits. Sorry?
But everybody is now saying, but the market is burning, is 30% below the level from the last year. So all the newspapers are saying, run away.
No, definitely. It's not that time. Imagine you're buying it now, for example, with 20 or 30% discount to the prices that were there at the beginning of the year. So now it's definitely way better time to start than it was at the end of the last year, for example. But that doesn't mean you have to put all the money you have right now in the market. Start with a small amount, start with a regular deposit, with some broad market ETFs, build the core of the portfolio like this, broad market, stocks, bonds, you can add some commodities. And then once you have the core of the portfolio being widely diversified, then you may add some sector or thematic or some trendy, attractive ETF if you want to, but you don't have to.
Yeah, I was going to say going to a robo-advisor can be quite useful because usually you can access them, play around with asset allocation, understand the different types of products, understand that over the long run, if you buy lower cost products that typically are ETFs that are indexed, you get better returns. And so I think playing with the robos allow you to be able then to have a conversation with someone to understand how to think about saving, investing, how much money to place where and when and how to do it. But I think over the long run, what you've heard from Martin, well, the two Martins, is, stay calm and carry on, right? None of us can time the market. I mean, market timing has never worked well for anyone. So the best thing you can do is really to stay calm and stay invested.
Yeah, I think if I may add to that, when you are now contemplating a start of your investments, I think it's really good to realize from the start that you're never going to get the timing right. So you should not worry about it. You should just start and maybe allocate over time if it makes you feel better. Also, you have to realize you will never find the perfect product. So you should also not worry about that. What you can do is select a good product by thinking about ways to diversify your risk or to lower your risk by diversification. Also, you can think about increasing your performance by lowering your cost. And you can think about not worry too much about the market timing, not try to sort of go in and out the market, because in the long run that also doesn't work. And if you sort of keep these simple rules in mind, I think anyone could really start investing today.
I totally agree with you. There is there's someone famous who used this popular sentence that the best moment to invest was yesterday, and the second best moment is today. I think it was Warren Buffett, but I'm not sure. I totally agree with you. Now we have the time when the market is declining, so it may come out. It may make us feel stressful, but actually, this is the best moment to start, because when is the better moment to start with investing? When it's cheap in the market. Thank you very much for a nice conversation. It was very interesting, and have a good day and see you next time.
Thank you, Artur. Thanks for the invite.
It was a pleasure.
Bye bye.
Bye.